Dear traders, my name is Dominic Scott and I would like to welcome you to our online education course. You are now 5 days from knowing everything about trading. This means that we have 5 teachings for you in total, each released one at a time. Having all at the same time can be overwhelming, therefore studying little by little will yield you better results. Before we get to the material, I would like to mention that this presentation is for educational purposes only and should not be considered as trading advice. Today we will start with the financial markets, which will give you the overview of different instruments, why price changes, and how does supply and demand influence price. So let's get right to it and start with the overview of the financial markets. First, let's talk about Forex, which is also known as the foreign exchange, FX or currency trading. It is a decentralized global market where all the world currencies trade. Currencies are important to most people around the world, whether they realize it or not. They are needed to conduct foreign trade and business. If you are a business and want to buy cheese from France, you will have to pay in euros. Therefore, if you're going to buy it from the USA, you will need to exchange the equivalent value of US dollars into euros. At the same time, same goes for traveling. An Australian visiting the USA will not be able to pay in Australian dollars as it is not locally accepted. For this reason, Forex is also the largest and most liquid financial market in the world. It is even bigger than the stock market, and the total volume is around 5 trillion US dollars per day. As a result, you can imagine that it can give you many opportunities at the market. So some of the currency pairs that can be traded with us are, as you can see, Euro USD, British Pound, US dollar, Japanese yen, and so on. Of course, the list continues and continues. Moving on to the next market, we have the commodity market, which is probably also the oldest forms of trading. It can be a physical or virtual place for buying and selling raw or primary products. They can be either hard or soft commodities. Hard commodities are mined, such as gold and oil, while soft commodities are agricultural products, such as wheat, coffee, and so on. As you can see, the commodities, indices, and shares that we have are all in the form of CFDs. CFD stands for Contract for Difference. This means that it is a contract between two parties, typically described as buyer and seller, stating that the seller will pay to the buyer the difference between the value of an asset and its value at the contract time. The benefits of a CFD compared to a traditional trading are that they can be traded with leverage. As a result, you will need less capital for an asset while increasing the reward potential. Also, CFDs don't have short selling rules, so an instrument can be shorted at any time. We will go into all of those details in another teaching. So now we can move on to indexes. Generally speaking, index is an indicator or measure of something, and in finance it refers to statistical measure of change in a securities market. In the financial markets, however, indexes are financial instruments that consist of hypothetical portfolio of securities representing a particular market or segment of it. For example, DAX 30 is a German blue chip stock market index consisting of the 30 major companies trading on the Frankfurt Stock Exchange. Then we have the S&P 500, also known as the Standard & Poor's 500, which is an American stock market index based on the market capitalization of 500 large companies having common stock listed on New York Stock Exchange or Nasdaq. So national indices can be also actually used as a benchmark and are widely regarded as the most accurate cause of the performance of a country. So if, for example, the S&P 500 keeps on making higher highs and is rising, then it is considered that the country, USA in this case, is performing very well. In general speaking, indexes are a great uh, instrument for trading as they are very volatile. Then, as we can see, we also have share CFDs, but I'm quite sure you all know what they are, so we won't go into much detail. But as shown, you can buy and sell share CFDs of Google, Apple, and many other blue chip companies. We just can't list them all on this slide, but we have them all listed on our website. As usually buying shares can be very expensive, trading share CFDs gives you much more flexibility. First of all, you can use leverage. Therefore, you can buy shares for as little as $100. Secondly, you can also short the instrument without complicated short selling regulations and costs. So these are most of the instruments that you can trade with M trading, but the list goes on. So now that we know the markets that you can trade, it is important to understand how does the price change. So first, let's talk about the base and quote currency in Forex trading. Base currency is the basis for a transaction. If you buy, the exchange rate shows how many units of the quote currency you could pay for a unit of the base currency. If you sell, the exchange rate shows how many units of the quote currency you should get for a unit of the base currency. You usually buy when you think that the base currency will appreciate versus quote currency, and you sell when you think that the base currency will depreciate versus the quote currency. So here we have an example instrument. In this case, it's euro dollar currency pair. The base currency in this pair is euro, and the quote currency is US dollar. So if you think that the euro will get stronger against the dollar, you buy, also known as go long. If you think that euro will weaken and that the dollar will strengthen, you would sell the pair, also known as go short. In order to be able to trade the markets, we need to understand what can influence the price of an instrument. As you can imagine, there can be many factors. Some of the examples are politics, geopolitical effects, technical factors, fundamental factors, interest rates, and commodity prices, of course, as well. For example, if you look at the Canadian dollar, it is very closely correlated to the price of oil. That is because they are one of the big exporters of oil. So, if the price of oil goes up, the Canadian dollar goes up. If the oil price goes down, most of the cases also the Canadian dollar goes down. If we look at the interest rates, how they influence price. If an interest rate increases, then generally speaking, the currency strength also increases. Interest rates are often set, uh, they are setting the long-term price direction for a currency pair. This is because traders look for a carry trade. Carry trades give traders a better profit because while the trade is on, they are generating uh, income because of the difference of the interest rate. So if we look at the political side of things, if there is a political instability in a specific country, it is very likely uh, to influence the strength of the local currency. Then we, of course, we have the major and minor economic data that gets released on a weekly basis, which as well influence the price. If we look at the technical factors, we could look at supply and demand, and of course other factors that the charts of price can tell us. In order to better understand the market, we also need to understand who are the main influencers of the market. The biggest influencers, of course, are the central banks, as they can change the monetary policies and thus also change the interest rates, which directly influences the strength of the currency. Then we have the governments, institutional traders, remittance companies, corporations, hedge and pension funds, as well as us, the retail traders. Then the question is, can we, the retail traders alone, influence the price? The answer is no, but we can follow the supply and demand and trade accordingly. I'm sure that what I've just said raises your questions. So how can I see the supply and demand in price? Before we get there, let's look at the laws of demand and supply. So the law of demand states that the higher the price, the lower the quantity demanded. The amount of a good that buyers purchase at a higher price is less. As the price of good goes up, so does the opportunity cost of buying that good. As a result, people will naturally avoid buying a product that will force them to forego the consumption of something else they value more. Moving on to the law of supply. The law of supply demonstrates the quantities that will be sold at a certain price. But unlike the law of demand, the supply relationship shows an upward slope. This means that the higher the price, the higher the quantity supplied. Producers supply more at the higher price because selling higher quantity at the higher price increases revenue. In order to better understand the concept, I will give you an example from your local grocery store. Let's say that a loaf of bread at the store costs $1. At the end of the day, the managers then realize that they keep on running out of bread. So at the end of the evening, uh, they the managers meet and they decided to raise the price of a loaf of bread. So the next day you go to do your groceries at the same store, but when you reach to the bread section, you notice that the price has gone up to $1.20. So you decide not to buy it. After a few days, the managers get back together and realize that the price was too high and now they're actually not selling enough and therefore they create a lot of waste. So they bring it down to 110. The reason why they do it is because they try to find the equilibrium where they would be selling and profiting the most. So just as it is with a simple product at your local grocery store, the same applies with financial instruments. But of course, it is slightly more complex as the price keeps changing at all times. So actually, this is where demand and supply zones come in. Areas where institutional traders believe the price is too high or too low. They are also known as overbought and oversold areas. As large institutional traders might not get all their orders in immediately due to liquidity, the area can get traded into numerous times until the balance changes and then there is a fast move in the opposite direction. As we can see from the chart, there are areas of previous buying and selling. So if we look at point 1, the that's where they have been entering trades previously, then price quickly drops and creates a zone. Then we have the point number 2 when the price reaches back to the same zone and it's being rejected. So it can be looked as an example where they keep going back to an area, accumulating positions, and then there can be a longer term move or a quick move. So this concludes today's video, as it was just to build you a strong base about the financial markets. Next video will cover all the information you need in order to actually start trading. But if you have any questions, feel free to drop us an email and we will get back to you as soon as possible. I would like to thank you for watching, and until next time.